Okay, good morning and welcome to this breakfast seminar, How to Stop Corporate Tax Evasion and Ensure Fair Global Taxation. It's great to see so many of you taking the time this morning. This event is organized by the TaxCapDev network. And TaxCapDev is a partnership between the Christian Michelsens Institute, the Norwegian Institute of International Affairs, and the Tax Justice Network Norway, as well as several partners within the Global South and affiliated partners in the Nordic countries. And the purpose of the network is to create and share knowledge to strengthen taxation in developing countries and to contribute to the development of new international research agendas. To achieve this, the network facilitates collaboration by bringing together researchers, policymakers, and civil society working on issues related to tax systems and capital flows in developing countries, with a particular focus on sub-Saharan Africa. So every year, the world loses significant amount of money due to multinational companies shifting profits to tax havens, creating unfair competition and weakening public budgets in many countries. This particularly affects developing countries, which lose what equates to approximately half of their health budgets to such tax avoidance, according to the Tax Justice Network. And one measure to combat this is country-by-country reporting, where companies are required to disclose key financial figures for each country they operate in, allowing us to see whether value creation aligns with tax payments. And today, we are joined by several researchers and experts in the field who will provide their insights. And I encourage you all to actively participate through questions and dialogue, and I hope the discussion will contribute to new perspectives and solutions regarding international tax cooperation. And the moderator of today's seminar is Frida Kvamme, who's a senior advisor at the Norwegian Tax Administration. And the first two speakers you will hear from is Jason Ward from the Centre for International Corporate Tax Accountability and Research, Australia, and Jonas Veland from Tax Justice Norway. So Jason, the floor is yours, please.
Can I sit in one of these chairs here? Okay. Good morning, and thanks for inviting me. And I'm very happy to be here. It's my first time in Oslo. Usually I'm based in Australia, so I'll just give you a little bit of background to who I am and what my organization does. It's CbCR. It's a terrible name, but I like to joke that we work with another organization called ICRIT, and at least we're not ICRIT, but they have a lot of famous economists who focus on key policy issues on global tax reform, so very happy to partner with them. CbCR is a relatively small organization. I'm based in Australia, but we now have a small team focused around the world, and I've just come from Amsterdam, where once a year we're now trying to get together and do face-to-face meetings. And we met with some colleagues from FNV, the Dutch Trade Union Federation, and we brought some trade unionists from Kenya who we're working with as well. So we had meetings in Amsterdam. So CbCR has been around for about 6 years. We started based on some work that was done before that, working with trade unions focused on their industrial policy issues, but using tax avoidance as a way to win for what workers were pushing for. We kind of function as an intermediary between the tax justice movement and tax justice advocates and the trade union movement. We do detailed forensic analysis of multinational tax avoidance to expose really what's going on behind the scenes, and this is why country-by-country reporting is such an important issue. So we do lots of work mostly with unions and civil society allies all around the world now. So we're operating in Yeah, and Canada, North America. We've done a little bit of work in Norway as well on a private equity company that is buying early childhood education, kindergarten, real estate. Um, so we're very small, but we like to push the envelope in terms of exposing multinational tax avoidance. And I think from my point of view, it's very hard to drive a policy change. It's very hard to get people interested in policy unless you have an example of why the policy changes are needed. And so we're constantly trying to put forward examples of what the problem is and how multinationals are gaming the system to avoid paying the obligations to the societies where they're generating income. So I'm going to start off by kind of highlighting a few points about why multinational tax avoidance is such a crucial issue. It's particularly crucial in the Global South because Global South governments have less resources to chase multinationals for one, but are also more dependent upon corporate income tax revenue as a source of revenue. So, you know, the amount of multinational tax avoidance belittles by far the amount of development assistance provided. I'm not going to stray in that direction, but some of the work we're doing in Kenya looks at specific examples of how development aid is actually subsidizing northern businesses rather than doing what it's intended to do in terms of helping improve conditions in the Global South. So I think there's no better example of inequality in the global system than tax. If you look at, pick a multinational company and it's paying a lower tax rate than the cleaners who work in its building to clean the building. And that's just a clear example of inequality and injustice within the global system. And frankly, if we don't address these problems, it drives far-right, anti-globalist, nationalist sentiment. And I think if people see, well, people are now very much aware of the inequality in terms of what individuals pay versus what multinationals pay in many cases. So take a company like Amazon or Microsoft, dodging taxes all around the world and exploiting workers at the same time. Also, I mean, I think we are facing major global climate crisis, and if we want to provide resources for governments across the Global South to begin to address that and to not develop further in ways that continue to destroy the planet, I think we need to make sure that those governments have the resources, and making sure that multinationals are paying their fair share in those countries is probably the most practical way to do that. Again, I've been working in Australia now for about 12 years and really focused on corporate tax issues for the last 10 years. I'm a very active participant in the Tax Justice Network in Australia. And I think in Australia, in order to sort of get reforms, we've shifted the debate from one that looks at the impact of multinational tax avoidance in the Global South to one that looks at domestic spending. And so if a multinational company is not paying its fair share, there's no money for education, public health, public services. So in order for us to finance our public services, and that enables us to work much more directly with trade unions who understand it's in their self-interest to make sure that multinationals are paying their fair share. I'll give one example. Some work that we did years ago before we set up CbCR was on Chevron. The large oil company. There was some headlines today. Finally, after years and years of pushing, there's disclosure requirements as exists in Norway for resource companies. And Chevron paid more tax in Australia than in anywhere in the world. And it took a long fight to get to get them to pay. They're not paying what they should and what they need to pay, but at least they're paying something. But that wouldn't have happened without robust civil society and trade union engagement to push for changing the rules and exposing what they were doing. What they were doing, they had set up a related party offshore loan in Delaware that basically we estimated would eliminate the entire, the equivalent of the national education budget in Australia. The amount of money that they would have avoided with their scheme was equivalent to a year's worth of education budget in Australia. So, um, excuse me. So we've in Australia we've done a lot of exposure of companies, and Australia's a bit unique. I think Norway is far ahead in terms of the tax transparency, that is public information on what companies pay. In Australia, we've had that for come November will be the 10th year of disclosure. So we already have a level of disclosure about all companies over $200 million in revenue, so what their total income is, what their taxable income is, and what the tax paid. And that level of transparency has actually been incredibly useful in driving further reform and change, because when every year people see that many of the largest companies pay zero in tax, it creates sort of a level of anger and a desire to address that problem. So we've been pushing for public country-by-country reporting in Australia for quite some time. And again, you sort of using public procurement as one angle to sort of say if companies are getting government contracts, they should be held to a higher level of transparency. And public country-by-country reporting is incredible. So we have a system now already where we have all multinationals, large multinationals are already doing country-by-country reporting, but that information is strictly confidential and not being able to be used by for procurement decisions, for example, or anyone. And even for investors and shareholders can't analyze what the risks are or what the structures are of tax payments in countries where multinationals operate. And I think it's important for the companies, it's important for the companies to, it's important for investors, excuse me, to understand the tax structures and the corporate structures of companies. And in particular, US companies tend to be the most aggressive tax dodgers, and the level of disclosure in terms of global tax issues for US companies has been abysmal, right? If you take a company like Microsoft, it has thousands of subsidiaries all around the world. It reports 7. 4 of them are in a tiny little wooden house in Carson City, Nevada, and the others are all in Ireland. And we know from, so this is the company that's facing the largest tax bill in the world ever, is facing $30 billion from the IRS because of years and years of shifting profits to Puerto Rico, where it paid nothing in tax. And sadly, that tax scheme was sold to them by KPMG and by the person who's now running tax at the OECD, who was part of the pitching that proposal to the good people at Microsoft. But Microsoft is an example of a company. It's operating around the world, increasingly getting huge government contracts because of the cloud computing business where it makes all its money, and paying nothing in taxes. So governments actually could hold it responsible and not offer it any future contracts unless it sort of, 1, becomes transparent, and then 2, begins to change its behavior. Sadly, I think multinationals tend to write the global rules in terms of how tax pays at the domestic level and at the global level. And when we've tried to reform this, it's an uphill battle because the tax justice advocates have very few resources compared to the power of the multinational lobbying and the governments that back them in. So we had, more than a year ago, we had landmark legislation introduced in Australia that would have been the best, was the full public country-by-country reporting, and we had the OECD publicly weighing in and opposing that because they wanted to keep all of that information confidential. And we know that behind the scenes, other governments as well have weighed in and made threats about Australia pushing forward with that level of disclosure. So what we have now is a slightly watered down version of that, but still the best in the world. I was hoping to come here and tell you that it has passed and that we were moving forward, and Norway should follow immediately. So I'm still saying that, and I'm still saying it's going to pass, but it hasn't passed yet. So the legislation, what happened in order to avoid the threats of retaliation that Australia was facing from other countries, we now have a system that looks like, essentially there's a list of 40 jurisdictions around the world that are widely recognized as the most abused jurisdictions for profit shifting and tax avoidance. And any large company with over 10 million in revenue in Australia, which is a very low threshold, will be required to report on all activities in those jurisdictions. So it's profits, related party transactions, numbers of workers, and taxes paid. And that awareness it's not a revenue solution, but it does drive further reforms, and it should, and we expect it to drive changes in corporate behavior as well. Because once people see what's going on, I mean, I can give you lots of examples of different companies and how they shift the profits, but once the sort of public sees this, I think it will drive further political demand to close loopholes that companies are using and abusing heavily. Yeah, we did a recent look at Facebook, and I think that the company that collects ad revenue from Facebook ads around the world in Ireland, I think its gross profits were equivalent to 11% of Ireland's GDP. I mean, this is completely artificial construct, and Facebook or Meta is using Ireland as a way to avoid its tax obligations in countries all around the world. And now Ireland, as a side effect of global tax reforms through the OECD, Ireland is now experiencing windfall income from corporate tax revenue, because companies that paid nothing in Ireland before are now being required to pay at a minimum level. And so Ireland is deciding what to do, is considering a sovereign wealth fund for its short-term gains from reforms in the international system. So we've been pushing for public country-by-country reform in Australia for a long time and globally, and one of the things that we've been doing is working with investors. And so we worked with investors to help develop the Global Reporting Initiative, the GRI tax standard, and we think that that's the best standard in the world for public country-by-country reporting. And that was developed through, in a multi-stakeholder process with experts over a number of years. And when that was adopted in 2019, we had investors, including, of course, Norges Bank, with $10 trillion in assets to back the demand for public country-by-country reporting. And in the last few years, working with allies, we've also filed a number of shareholder resolutions at US and one Canadian company in order to require public country-by-country reporting following the GRI tax standard. So the first one we filed was at Amazon, whose tax avoidance is sort of baked into the DNA of Amazon. And it's sort of model from the beginning, from its early days. Amazon challenged that resolution. 2 minutes, okay. And we've prevailed and then have subsequently filed those resolutions at a series of other companies. So what we have in Australia in terms of public country-by-country reporting is much stronger than what is coming forward in the EU, because there's less loopholes, less exemptions, and a broader geographical coverage. So we're very excited about the potential of that, and we're very much hoping that globally there will be a drive to sort of converge on a standard based on the GRI tax standard so that public country by country reporting becomes the norm everywhere. So once Australia does it, the sort of the resistance from both the corporate and governmental side becomes a lot less, because if you're doing it in one jurisdiction, people from everywhere around the world can get it from other jurisdictions. And right now we have a process where the EU has a directive on public country by country reporting, so it's a positive step in the right direction, but a fairly weak one with lots of loopholes and exemptions. We have the Australian model. We have some initiatives through the SEC in the United States, and also in the United States we have FASB, the Financial Accounting Standards Board, which has already set new reporting standards, which will be a major step forward. But these are three competing standards, and what we need to do for the sake of companies as well as everybody else is converge on one standard. And we did definitely think that the GRI tax standard is the way to go, and we're hoping that Australia pushing forward on this will lay the groundwork for other countries to follow. And we're having conversations with organizations like the South Center and kind of talking with tax authorities across the globe. There's no reason, once there's a model somewhere, why a country like Kenya or Pakistan doesn't go ahead and require public country by country reporting as well. So I'll end there.
Thank you, Jason. That was very interesting presentation, and very inspiring, I have to say. I thought just before we go ahead with the panel, I'd say just very short, just a few things on the situation in Norway, because we're hoping to sort of build on what Australia has showed is possible unilaterally, and do the same thing, or hopefully better, in Norway, which is a big ask, but we're hoping for that. So you mentioned the Norwegian Sovereign Wealth Fund, which is the biggest in the world. Most people are probably familiar with that, but they have a couple of expectation documents, and one of those expectation documents is on tax and on transparency. And in that document, they expect companies to publish country-by-country reporting, and they encourage them to use the GRI standard, which is the best, the leading standard. We agree. And we have heard back from our partners in civil society around the world that they are very happy with the Norwegian government pension funds work on tax and transparency. Which is somewhat surprised us, but it's that's good, I'd say. And of course, it's one thing to have it in the expectation document, but it's another thing to follow it up with actual policy and actual action. And so we're hoping to see more of that. But anyway, we're very happy to have gotten that expectation documents in the first place. Also, KLP is another very important Norwegian institutional investor, but I won't say too much about them because they'll talk for themselves. But the point is that it's from the investor point of view, it's a very good thing that we have institutional investors in Norway which are really leading in trying to work for tax transparency. And it's also a general theme, as you pointed out, Jason. It's I wrote down that there are some shareholder votes that are up to 30% in some of the largest companies in the world for public country-by-country reporting. And in a shareholder vote in Microsoft in 2022, I think there was one last year as well, but in 2022 it was 23% of shareholders voted yes to country-by-country reporting. So that's sort of the non-mandatory side, or the investor's perspective. But in addition, of course, we have some regulations at work in Norway, which we are sort of hoping to push for and hoping to show that what's being done in Australia is something we can do in Norway with the same resolutions. So we have 2 resolutions for public country-by-country reporting in Norway, which has been passed by Parliament in 2016 and 2021. So what we're waiting on now is them to be implemented. But we're a bit skeptical of the finance ministry's plans because their idea of implementing this is to implement the EU country-by-country reporting, which Jason mentioned is not the best standard. I've written down some criticism of it. It's not full country-by-country reporting. You only get country-by-country reports from EU countries as well as some like random tax havens, and not the biggest ones at least. And if a in-scope company considers the information to be commercially sensitive, they can delay reporting for up to 4 years. And in addition, it's a very high threshold, revenue threshold to be included. You have to have a turnover of 750 million euros for 2 consecutive years to be included. So these are things we don't like about the EU CbCR, so country-by-country reporting. So we've been working with Parliament to try and stop the Ministry of Finance from implementing this as a way to meet the requirements from the Parliament. And last year, in the budget negotiations for 2024, the Socialist Left Party and the Labour Party and the Centre Party, which is sort of the budget majority in Norway, agreed to reject the finance ministry's plans of implementing the EU country-by-country reporting standard as a way to meet these 2 parliamentary motions. So we're happy to see that, and that sort of leaves the door open for what comes next and what should be the next next way forward for these 2 parliamentary resolutions. And we're hoping for a Australian-like GRI 207 for all countries around the world. Speaking of that, I just wanted to mention that we're having another event later today with politicians from the Labour Party, from the Conservative Party, and from the Green Party. It's at Kulturhuset at 4. So if you want to see the sort of political dimension of this, I recommend coming there. Jason will be there as well, and I will be there as well. So expect to hear the same thing. Okay, I just want to close on a very important point, which is that unilateralism works. And country-by-country reporting is a very interesting policy because if one country implements more tax transparency, it creates tax transparency many places, because a in-scope company in the given country has to report for all countries that they they exist in. If you can see sort of the effect that if Australia implements this and Norway implements this, you have sort of so many countries which end up being covered because the in-scope companies are invested or have activity in so many countries. It's very important to push for this in Norway, not just for Norway being a country that wants to go forward, but because essentially it creates more transparency globally. And this is especially important for developing countries because they don't have access to the existing regime of country-by-country reports under the OECD. So it's very important for them also to be able to see the companies that are in their country and how they are behaving. Yeah, and just super final. Public country-by-country reporting has also been shown to work. We have had for the past 10 years in the EU not the bad EU directive I just mentioned, but another one which is just for banks. And research done on these reports show that for the in-scope banks, profits in tax havens have fallen, subsidiaries in tax havens have fallen, and we've seen a significant increase in effective tax rates for these companies. And this is especially true for banks who have like high reputational risk. So that's all to say that this is a good idea. All right, that's all I had. Now I think we can just welcome the panel to come up on stage. I haven't written down your names, so you can introduce yourselves. Thanks.
Now it's on. Now it's on. Now it's definitely on. Okay, great. We'll start again. My name is Frida Kvamme. I work as an analyst in the Norwegian Tax Administration. I'll be the moderator of this morning's conversation. And before we begin, I am to talk briefly about the data we receive in the Norwegian Tax Administration concerning the CbC data. So the data that we receive is exchanged through the OECD standard, which means that it applies to enterprises that have above 750 million euros in revenue. And we receive this data from Norwegian companies operating in Norway and all of their activities abroad, and then we exchange this through the international agreements. And then we also receive the country-by-country reports from the foreign multinationals operating in Norway. And the use of this data is regulated by the OECD standard. So we use it for risk analysis, especially pertaining to BEPS risk, especially transfer pricing as well, and also broader economic and statistical analysis. And the main goal is to better understand the company's tax strategies, but more specifically to better target audits. And then when it comes to the publication of this data and the exchange, we do send it to the OECD. And the OECD now publishes this on a country level, which is better than before, which where it was on continent level mostly. So countries send their own country-by-country reports. So Norway then sends about approximately 70 reports to the OECD, but we aggregate it on country level before we send it. And if you have below 5 companies operating in a country, the confidentiality level then kicks in. So then you have to aggregate it on a higher level, meaning that we do not send information on all country level if the number of companies operating there is below 5. So yeah, that's what we use it for, and that's how we use the data in the CbCR in the Norwegian Tax Administration. So let's start the conversation. And I think we'll open with that Heidi and Elisa can introduce yourselves, because we've heard from Jason already. So Heidi, do you want to start by?
Yeah, I'm happy to do that. My name is Heidi Finskas. I'm the Director of Sustainability at KLP, which is one of the Norwegian institutional investors who have been working on the tax issue and also the country-by-country reporting specifically. KLP is a pension fund. We're managing pensions on behalf of local municipalities and health enterprises in Norway. So we do have a close link to the public sector in that sense. And we're also a mutually owned company, meaning that our customers are also our owners. Again, local municipalities and health enterprises. So what we are doing then as a pension fund, we are investing globally. We have an investment strategy that it basically is to reflect the global economy. So we're investing in a large number of companies in most sectors and in large parts of the world. So in our portfolio, we're of course meeting the challenge about lack of transparency and the tax issue in many of the multinational companies.
Good morning from my side. I'm Elisa Kasi-Eberhardt, and I'm assistant professor at NHH, Norwegian School of Economics, since a couple of years. I did my PhD in Germany on international taxation, and I was also working private sector like private equity and financial controlling. And my research focused on how tax policy affect corporate and individual behavior. I won a European grant to work on automatic exchange of information on financial assets and how it affects offshore tax evasion. But I have also projects on corporate behavior and how it is affected by increased transparency. So for example, one that is related to the today discussion is on looking at UK. So UK is particularly active, but also on not only on country-by-country reporting, but also on more narrative disclosure. So they mandate a large multinational to disclose on their tax strategy. And we look at how it affects company behavior, real behavior, but also reporting behavior. And actually, we don't see so much optimistic result in a way that this type of disclosure can be used as greenwashing to portray yourself as very good corporate citizens without changing your real behavior.
Interesting. We'll get back to that. So is this mic still on? Or yeah, okay, now it's on. When I can hear the echo, it's on. I think we'll start off with sort of an open question. Jason has spoken briefly about the importance of this. But I want you all to say something about if you think it's important and whether or not you think it should be public. So maybe, do you want to start off, Heidi?
Well, the obvious answer, yes, it is important. And why is it? Well, from an investor point of view, the country-by-country reporting is actually something that we've been working on and supporting or being an advocate of in 10, 15 years almost, at a very early stage when the idea was, or the concept was being developed. And why is that? Well, first of all, this is about increased corporate transparency and also accountability. It gives valuable information on a corporate level in terms of revenues, in terms of the number of employees, taxes paid, etc., etc. And that is on a country-by-country level. And of course, it matters if you're an extractive company, for instance. Are your mines in Tanzania or are they in the States? It is, of course, financially valuable information that is useful for an investor or a financial analyst that is trying to understand a company, its operations, and its future value as good as possible. And also, it's about assessment of tax risks. Because we're, of course, what we are concerned about is the future value of a company. And if a country or if a company is a very aggressive or has an aggressive tax strategy or aggressive tax avoidance, it is, of course, increases the tax risk. It's about regulatory penalties and fines, and it's also, well, in case there are changes to tax policy in certain jurisdiction, a company is, of course, very valuable, or we will be heavily impacted by that. So it's also about understanding the tax risk. And of course, also the moral perspective, the ethical perspective. Many investors are concerned about that. We want a sound global economy, and also we have an international perspective. It's not in our interest to exploit certain areas of the world. We are dependent on a sound global economy. And reputational risks, etc., etc. So there are many angles from an investor point of view as well as to why country-by-country reporting would be a valuable tool. And your question, should it be public? Yes, that's the whole point. Because if it's not public, then it's not possible for an investor or a financial analyst to use. So that's the whole point.
Great, thank you. Jason, do you want to?
Yeah, just if I could add a few. I mean, I completely agree with everything there, but a few other points. I mean, I think that from an investor standpoint, you don't want to invest in a company that is generating short-term gains by exploiting loopholes in the tax system. If you're an investor, you want to invest in a company that has a wise long-term business strategy that's innovative and competitive, and so the lack of transparency actually stifles competition and monopoly. And if you're a universal investor investing in all kinds of companies, you want to have ensuring competition, not giving an upper hand to companies that are behaving badly and exploiting loopholes as much as they possibly can. I think there are more enlightened investor attitudes towards tax transparency in Europe, and we've been sort of using the shareholder resolutions as a way to kind of educate and move investor sentiment in North America. And I think that's actually been working, and we've seen a number of large public pension funds in the US have been backing our resolutions, and we've seen a growing number of them shifting in that direction as well. And I think they, as a universal investor, and there's lots of examples of public pension funds in the US that have invested in investments that have undermined their own tax base. And so here's money that's undermining the long-term future of a public sector entity, a municipality or a county or a state, because its investments are going into something that is actually extracting rather than producing returns. Yeah, and I think that just also from a, not specifically from a tax point of view, but from a company and from an investor standpoint, it's crazy to invest in a company like an Amazon or a Microsoft. These are all global companies, and we don't know anything, not just about their tax payments, but about the size of their revenues in countries like India, China, and Brazil. I mean, this is the future growth of where the economy is expanding fastest, and how investors are going in blind in terms of the risk issues, which are substantial and growing. I mean, Microsoft is facing $30 billion in tax assessment. Coca-Cola is facing $16 billion in tax assessment. You're an investor in these companies, and this is going to hit you directly. And another one is Amgen, a large American pharmaceutical company that's facing a shareholder class action lawsuit for $3 billion in back taxes that are owed from tax schemes.
Well, thank you. That is a very good and interesting answer. But Elisa, what do you think? Can you also mention on the effectiveness of these measures not always having the wished effects? So what do you think about country by country reports?
Yeah, so this is one of the measures. There are much more, as I was saying, of tax transparency measure, focusing on that one. I would say that compared to Jonas' point, the results are a bit more mixed in the tax revenue. So especially when you think about the tax revenue and we think about the public one of banking, but also the private one with the scientific evidence in Europe, it didn't, in the short run, it didn't rise so much revenue. At least the effective tax rate changes were less than 1%. But it like when you look at firm reaction, you see that it bites. So this type of regulation are scaring them because they have strong reaction, also trying to avoiding, and also taking real action. So we see more and more research actually pointing on the fact that multinational company, they, for example, reduce their assets in a high tax country to align that they don't have so much profit there, but then they don't have also so much activities. Or also, we have evidence of relocating from very little islands, so very aggressive tax haven that might raise more scrutiny and might hard to justify the activity there to, for example, European tax havens with substance like Ireland, Luxembourg, and Netherlands, where we see that there has been an increase in labor and capital there. But I still think that we need a little bit more time because I think that, or we see that this information is useful. So I want to wait and see how like tax authority can use for better audits, because that was the whole point, right? And we see that, for example, from German evidence on country by country reporting, researcher, for example, can have a much better picture of company activities. So as I will have. And also NGOs can use this information as actionable information. In the past, we saw that just even listing the subsidiaries, like is required in UK, enable ActionAid to do a shaming campaign. And this resulted in a reduction in tax avoidance and actually a better disclosure of subsidiary. So I think the information is useful. We need a little bit more time to see more promising effect on tax revenue, I would say.
Got it. But taking the business perspective, since you now talked about the actual real effects that they adapt to these rules, sometimes by actually moving employees and assets. And so, yeah, taking the business perspective, do you see the business side of it, the compliance costs and how it actually affects the investments? Do you have any sympathy towards that side, Jason?
I do have some sympathy towards that side, but I mean, every time that these reform measures are put forward, we get the same set of, I'm refraining from using foul language here, but the same set of ridiculous arguments, to be honest, right? the compliance burden on country-by-country reporting, any multinational that is going to be doing it publicly is already doing it confidentially, and so the formatting things are slightly different. And I mean, in Australia, the opposition to this has made arguments that, oh, well, maybe we should report on a regional level. This is actually adding to your compliance burden because you don't. I think the compliance burden is a myth in order to not go there. But I do. And Jonas made a point about unilateral action. I mean, I think unilateral action is needed to drive multilateral action, and we've seen this previously with the digital services tax. There would not be a OECD Pillar 1 discussion had it not been for a proliferation of digital services taxes. And I'll just give you a mild anecdote from recent lobbying by corporations in Australia. There was a company, SC Johnson, which is one of the largest consumer goods companies in the world, a private family company, and they were arguing to have a 5-year exemption because they'd gotten one in the EU to not do public country-by-country reporting. And this company had a $25 million related party loan with a subsidiary in the Netherlands. All of its goods were purchased from a subsidiary in Malaysia. And the Dutch company was owned by Switzerland. And so they're keen they have something to hide, and they want this exemption because they don't want the truth of what they're doing, not necessarily in Australia, but in other jurisdictions. And if Australia reports it, then it's available globally.
Heidi, did you want to comment?
I think it's important for you to know that the new reporting requirements to companies are massive. And that's not only for companies in general, that's also for us in the finance industry. Where the EU has introduced a lot of new requirements. It's about sustainability reporting, and it's also requirements as to how to integrate sustainability. So we're really talking about a paradigm shift. We're talking about the time before the 2020s, and we're talking about 2020s going forward. It's massive. It's a tsunami. And I think we have to acknowledge that because even in KLP, I mean, we've been working on this for 2 decades. We have reported a lot, and I'm very comfortable as to where we are. But even we're spending a lot of resources now just to improve our systems and improve our reporting and do everything at a high level, because the aim of the EU is to really bring up sustainability reporting up to the same level of quality as financial reporting. And that is really a good thing. So the EU is doing now exactly what we have been asking EU to do, to introduce standards, to introduce reporting requirements, because now this will help us to have the data that we need to analyze our portfolios. So it's a really good thing, but why we're doing that, there are 2 things that we have to keep in mind, and that is we're not reporting as a goal in itself. It's not the reporting as such, it's reporting as a tool to improve, as a tool to become even better at integrating sustainability in business strategies and be future-proof. And the second, I'm really grateful to the EU and for the for the powerful acting that they're doing now. But we also have to remember this is about the EU, and we always have the discussion, but what about non-EU companies? Are the reporting requirements that the EU is introducing, is it a good thing for EU companies because it will make them more prepared, it will improve the strategies, etc., etc.? Or is it a negative thing because now we're using a lot of resources on this in the EU while Chinese or other companies are using much less? So we always have to find, it's not an argument against, but it's always a balance that we have to strike. And of course, what the EU is doing now is indeed influencing what's happening in the rest of the world, and that's a good thing. But then coming back to country-by-country reporting, we have been an advocate for that and always proposing that because we don't think that it's not a compliance burden. And also, this is a hypothesis, I don't have the facts behind it, but I think that most of the companies, country-by-country reporting is based on figures that the companies already are having. So it's not a significant increase in reporting burden in that sense. So in that sense, the other sustainability reporting requirements are indeed a much more difficult challenge or more reporting burden.
And Elisa, so now we've talked about all of these other measures being introduced, but there's also other measures being introduced within tax transparency, as well as all of these ESG measures. But so looking ahead, do you think we can end profit shifting with all of these measures?
If you take them in isolation, so only tax transparency measure, I would say no, as I was saying, like so far it was not optimistic, but I think it's a very important measure. It's a bit maybe easier certain measure than the global minimum tax or changing the tax system. So I think it's important, but it's also, as I was saying, like it's not always that more transparency is good, because if you think about the UK case, it ended up that company could have used it as a tool to, so after the regulation we see, before it was voluntary, many companies were doing voluntary. After the regulation it became compulsory with standard category of what to discuss, and then it became more boilerplate, so that the disclosure were very similar and you can't learn so much. And also if you think about country by country reporting, and I really care about that discussion, because if you see like the evidence I was mentioning about moving capital and labor, we are moving from profit shifting to labor shifting in a way, and because company now, the value driver is intangible, for many companies, intangible asset and high skill labor. If you think about scientists and software developers, they are mobile. So I think we really need to consider that side aspects, that it's going to turn into we fix the corporate income tax competition, and now we are opening the stage to social security and personal income tax competition. And you see there is, for example, in the EU Tax Observatory report on global evasion, there is a really nice chapter showing all these measures of countries to attract high-skilled labor and net worth individuals. I come from Italy. There is a lot of measure in Italy for that, for example. So I'm really afraid of starting a new era of like personal income tax. And for developing countries, still corporate income tax is very important, but for OECD country, it's much larger, the piece from personal income tax and social security contribution. So I think we need to reflect also on this potential unintended consequence of this no longer profit shifting, but real shifting, so to say.
Yeah, so there's definitely an aspect of competition here, both when it comes to the employees, as you say, and the skilled labor, but also when it comes to differential regimes, like differential requirements from the EU compared to other countries that doesn't have this. So I want to ask you, Heidi, as an investor and the broader sentiment in the investor environment, are everyone like you guys? Is everyone positive, or is it just what is the broader sentiment among in the investor environment?
No, it's not on the top of the agenda for all investors. But so in that sense, tax issues is quite a new topic on the investor agenda, I would say, but increasingly so, and that's really very reassuring. So, for instance, you talked about the shareholder filings or shareholder resolutions, because voting at annual general meetings in companies is, of course, an important channel for us to influence and exercise our ownership rights in a company. And we've had shareholder resolutions for many, many years on various topics, obviously. Tax resolutions is quite a new trend. We're talking about 3 or 4 years, maybe roughly 2, 3 years. Yeah. So as you can see, it's a very new topic to be raised at annual general meetings by shareholders. So I think that is an answer that we're definitely seeing an increased. Well, the topic is more on the agenda, and also getting significant support, I would say. So this year, KLP was part of we were part of the filing of 4 shareholder resolutions. Only one was accepted, and that was a shareholder resolution at Chevron, asking for country-by-country reporting. 15% of the shareholders supported that resolution. And it's not too bad, actually. It might sound a little, but it's not too bad for being a shareholder resolution. And it's indeed a very clear signal to the board and to the company as such that this is something shareholders do care about. And also I could add to that as I said, we filed 4 shareholder resolutions, only one was accepted. And why is that? Yes, all these were in the States. Because in the States, they have a system where SEC, the Securities and Exchange Commission, they are approving if a shareholder resolution can be put forward or not. And now we have filed a petition to the SEC. It's the FACT Coalition that is behind that petition, and it's signed by 87 investors. KLP is one of those. And those 87 investors have a total assets under management of $2.3 billion US dollars. And that is a significant amount. And the petition is about that, asking for requirements on the US companies to report on a country-by-country basis.
I should have a short follow-up question. I don't know if you can answer it, but has KLP ever divested from any companies due to insufficient transparency?
No, not directly, no. Oh. We do have a divestment policy. We do have exclusion criteria. And we also have a general criteria based on, ethical business conduct, basically. So we do have a criteria for systematic, severe violations of that criteria. So of course, we do have it's a part of our strategy. So far, it hasn't happened. So we've chosen to use dialogue to vote and support investor collaboration to raise the question, raise the topic instead.
Very interesting. I forgot to say initially that we have 20 minutes at the end for questions from the audience. So if you have some, please think about them. So that's in about 10 minutes. And so Jason, what other measures have you, for instance, been working on? Or what other measures do you see could be relevant for Norway to introduce that perhaps Australia already have?
Well, I think in the long term, what we would really like to see is a form of unitary taxation, but understanding that it's going to take a long time before we get there, and that if we're looking at companies as a whole, which is how they look at themselves and how they operate, then whether they artificially shift money to this tax haven or that tax haven becomes irrelevant. And I think if we have a unitary system, and I think this can be done on a unilateral basis in order to get to a multilateral basis as well, you begin to tackle the problem of uneven resources between tax authorities, particularly in the global south, but frankly everywhere, and multinational corporations. So you're looking at a company as a whole and then coming up with a fair, transparent formula that would reduce regulatory burden, I think, for lots of companies. And this system already exists in the United States. There are 27 states that have a form of unitary taxation for state corporate income tax. It has some egregious loopholes that we will be working with allies in the U.S. at the state level to eliminate. But I think that there are existing models out there for unitary taxation, and it was a key component of the OECD Pillar 1, which I think is likely to die a death, but at least it has elevated the concept of unitary taxation there. So I think in the long term, that's the simplification and increasing transparency in the whole global tax system. Understanding that it'll be a long passage to get there, but I think in terms of that's where we need to look in the future.
Yeah, that was a bit pessimistic about the Pillar 1, but I guess we'll see. But also, I heard about this tax practitioners board that I think Australia has, right? Could you say something about that and what it is, or
Yeah,
how
so
does
I
it
have
work?
my colleague at the Tax Justice Network in Australia has been sort of more focused on that than I have been, but we've had a huge scandal in Australia with PwC, and it's leading to a series of proposed reforms about how the accounting industry works. And so the PwC basically had confidential access to proposed tax reforms, and basically despite signing non-disclosure agreements, which I've signed those same agreements in discussions with Treasury, they immediately monetized their inside knowledge and sold it to US multinationals so that they could design a new scheme loophole as the reforms were coming in. And so that's led to a very stark look at the whole accounting audit industry. And there are huge conflicts. These have been facilitating tax avoidance for multinationals for years and legitimizing it and okaying it. And we have a system in Australia, and it happens elsewhere around the world, where you have the same external audit company doing audits, certifying the accounts of a company, and then also at the same time providing tax services and tax advice. And that's just a clear and gross conflict of interest and has to be ceased. You can't have somebody signing off on the accounts of a company while advising them on the best tax avoidance schemes to be using. So that we will have some, and there are reforms in Australia and around the world that are requiring disclosure of tax schemes and actually holding these types of firms accountable for the schemes that they're selling to multinationals.
So the EU has their framework for disclosing tax regimes from tax practitioners, which is called the DOC 6, isn't that what it's called? Which we don't have yet in Norway. But are there any research on the effects of these type of measures?
Yeah, so there are initial research on that, and it's more optimistic than the country-by-country reporting. So at least the first study was showing a stronger effect of 2 to 3% of increase in the pre-tax income reported after this mandatory disclosure rule has been introduced in Europe. But it's also heterogeneous because as usually, like also the public country-by-country reporting directive, there are some level of freedom in the countries, and one is about, for example, penalties if you don't report to the tax, so it's private information, and they show that, for example, if the penalties is fairly low, then there is a milder effect of this reporting. But also very important, the legal professional privilege, because in Europe it's not in the directive, it's a national matter how it is the legal professional privilege. But in some countries, for example, it extends to banks, and in some countries more strict, which means that as a tax advisor, because it's a third-party reporting, it's not a direct reporting, then it hinders the effectiveness of this regulation because they can waive the obligation to report on by saying like this is a client secret, and then this paper shows that also there we see weaker effects. So yeah, there is some work to do, but it seemed a useful legislation.
Yeah,
so far.
There's no such thing as a perfect legislation, is there? No. Okay, so we're closing in on time now, but I was just wondering, like, if Australia has this public CbCR and the EU as well, does Norway need its own? Because I mean, we would see a lot of the same companies in the Australian one.
I would definitely say yes, Norway needs its own because of the different mix of companies. So the EU Tax Observatory did a really fantastic analysis comparing Australia and the EU and the coverage. And the approach that Australia is taking, even though it's watered down from the initial sort of full country-by-country approach, is still showing significantly more companies covered from lots of different jurisdictions. So a majority of US companies, but not all. And so because of the footprints of different multinationals where they operate, the more jurisdictions that do it, the more information that will be out there. And ultimately, I think we do want to see a situation where there's one global standard for public country-by-country reporting, and the more countries do it stronger and better, and Norway can jump ahead of Australia and require full country-by-country reporting. We do need to get to that point where we have a global norm and a global standard, and the more jurisdictions that go that way, the sooner we get to that point.
Noted. Well, I don't work in the ministry, but so it's not up to me. Okay, as we're closing in, and we talked a bit about the future, and I mean, one always says this, but I feel like it's particularly true right now that we do live in a time where it is more conflict than before, at least the last 20 years, and it is uncertain and more competition. So what do you guys think the future will look like for tax transparency? Is it necessarily so that we will move towards more openness, considering increased competition between continents, regions, and everything? Or what do you think, Heidi?
I think my generation is a generation that is used to that everything is becoming a bit better every year. I don't think that's the situation any longer. It's definitely a world in unrest, and I think we just have to continue working on harmonization, collaboration as much as we can, because it's not happening by itself these days. So collaboration is at risk, and also that on all areas, and also on tax as such. That's my belief. So it's not happening by itself. We have to continue supporting collaboration on all angles.
What do you think, Elisa?
Yeah, I think that, so for me, I'm optimistic on the part of tax transparency moving forward because of the push from sustainability angle, that clearly tax is part of that, because corporation is the way they show a contribution to society. But there I see also really the necessity to harmonize, because again, it's like of the GRI standard, one part is country by country reporting, but a larger part is also tax strategy, tax government, tax risk. I think tax risk will be a key disclosure in the future. And there is like company now can pick and choose which standard they like, the GRI, the other, like the Global Economic Forum also as a standard, and there it makes a bit more leeway to describe yourself as you want. So I think there it's, I would really wish for an harmonization so that we can get useful information, and also as a researcher, it would make our job easier, and also more accurate analysis, because you can compare corporation and what they say, and the reporting numbers when you have different formats is very hard then to do an analysis.
Well, as a fellow analysis, I just have to follow up on that, because what is the data like for you guys when you do research on corporate taxation and data quality?
Yeah, so I really care about tax transparency, because when you do research on taxation, it's very limited, the access of the data you have. So we mainly work with financial statement numbers, where you have at most, like currently, mainly just the tax expense and the book tax expense. And we have only financial income, not taxable income, which can be very different. So it's very challenging to have an accurate measure of what the firms pay. And it's like Scandinavian countries has a long tradition of giving the data open application, but that's rare. It's improving. And I think one of the biggest challenge is like not having a centralized data set, so to say. For country by country reporting, we have multinational providing it voluntary, but it's all sparse in the website, so it's very costly for a researcher to collect them. And often it's a PDF, so it's not machine readable, and it's very hard to extract the information, like it was for the public country by country reporting of banks, very challenging. And then again, because the European directive leaves some freedom on, for example, the languages in which you write and the currency in which you report, it makes very hard for researchers to then work with this data and understand this data. So I would say it's like data limitation. The DAC6 data are not publicly available. We need to use leaks data when it comes to understanding tax arrangements. And then there is a challenge of publications sometimes, because they are classified as stolen data. So we need more data, which is improving. But I would also really say we need more better data, in a sense, centralized and machine readable and comparable. So, yeah. but I'm optimistic. So
Great.
it's going backward.
Optimism is good. So what do you think about the future then, Jason?
Well, I think we have to. There's the issue of multinational tax avoidance has reached such a point, and there's been. I do want to say there has been significant progress, and there's lots of very positive trends out there. But it's unsustainable to have a situation where the largest multinationals in the world pay nothing for public services, and individuals and small businesses who can't afford accountants and don't set up in tax havens are subject to footing the bill for the people who should be affording the most. And I've been doing a fair bit of work in Kenya recently, and Kenya has desperate needs to increase public spending on environmental issues, on public health, on education, and they can't do it because they're spending debt money. They're paying back foreign debt, and there's lots of multinationals operating in Kenya and countries around the world that aren't paying what they should, and we're not going to solve the sort of the inequality issues, the climate issues, unless governments everywhere have the resources that they need to fund the public services. And I think Norway's in a different situation than lots of other countries, but we're countries around the world are sort of in austerity measures of one form or another. And if there's the political will to actually collect what is due from these companies, we have the ability to fund high-quality public services that address the issues that we need to address globally.
Thank you, and thank you to the panel for this very interesting conversation. So we have time for questions now, and I think there's perhaps there it is. There's a microphone right there. So I see there's one man on the. He can go first, the guy with the glasses. So please state quickly your name and perhaps your affiliation if you want to, and then address your question.
Yeah, thank you. I'm Axel from the Norwegian Center for Human Rights. I do not know much about tax at all. But I worked a bit on corporations and human rights. And there's a parallel, that's why I'm going to talk just a little bit about it. You have had this narrative that has been quite dominant in some circles, that it is a win-win for the companies to adhere by human rights. You have reputational gains, you have more, motivated workers and whatnot. Whereas there's also ample evidence that many companies have lots of wins by not adhering to human rights. And I apologize if I misheard what you were saying earlier, but you said I picked up something to the effect that investors do not want to make kind of risky short-term investments. And my question then would be, is that really the case? Can you generalize like that? Are there not a lot of investors who also want to make kind of quick and risky money? Thank you.
Yes, so I perhaps made a slight overgeneralization, and I think this is what we see in the results in Chevron, because the shareholder base of who owns shares in Chevron are generally, they're people who are concerned about short-term profits and profits at any cost, whereas in other companies that have a different shareholder base and a different set of investors, I think the company where we've had the most success, where we got the highest results, was Brookfield, which is a $800 billion alternative global asset manager. And so you have a broader, diverse set of stakeholders there. And it is absolutely the risk issue. As regulations get tightened, investors are facing serious risks about companies getting caught for exploiting loopholes. So it is investor sentiment is definitely shifting towards that. But just one thing in terms of the human rights connection and other issues, what we tend to see is that companies that are willing to pollute the environment, to exploit workers, are generally more likely to be willing to do aggressive tax practices. It's sort of as a general notion of externalizing your costs on society, and making public your external cost and privatizing your profits. And that's just not a sustainable approach in the long term. And we're trying to do an analysis of sort of actually to determine whether there's a correlation between companies that have violations on labor, health and safety, environmental issues with aggressive tax avoidance. And we haven't crunched the numbers yet, but it looks, that's my expectation, is that we'll be able to show that in clear numbers, that there is that correlation. And I mean, just the other connection too is we work with a lot of trade unions on labor issues with companies. And if a company if a subsidiary in a particular country is able to tell the tax office that, oh no, we're running at a loss, they're also able to tell the workers that, sorry, we can't give you a pay raise, or in fact, we need to cut your wages and working conditions. Whereas that company is genuinely, it's the paper loss because the profits have been shifted through various transfer pricing means to some other jurisdiction. So I think these issues are very linked together in very clear and strong ways.
You want to comment on it?
Yeah, I just want to say that there is a strong argument for country-by-country reporting, independent of what kind of investor you are, no matter if you're a long-term or a short-term. Because if you're a long-term investor, you have the tax transparency, it's sort of the argument as well. But if you're only a short-term investor who doesn't care much about the sustainability perspective, it's still valuable financial information that also a short-term investor would be interested in.
Thank you. I think Andreas has the next. Yeah, that's fine. I can do it.
Thank you for a great discussion. Andreas, Head of Tax Justice Norway. One dimension we haven't entered is there is a process in the UN with International Tax Cooperation. I just wanted to hear if you have any perspectives. I guess not all of you are in the same sort of focused on that, but what kind of impact do you think that can have?
Have any more questions before we start answering that? No? No? Then I'll think. Who wants to answer that?
I'm happy to jump in. I mean, we're very happy to see the progress and the discussion being elevated to the UN, and think that's a potentially a better venue. Well, not potentially, definitely a better place for these decisions to be made, rather than in the OECD, which has been the location for all of these debates up till now. So it's a huge step forward. I do have concerns that the problems that exist in terms of the OECD, in terms of multinational lobbying, in terms of lobbying by the US government and other governments that are acting on behalf of the multinationals that live in there, that are headquartered in those countries, will also stunt and be a problem in terms of making progress at the UN. So it's a better jurisdiction, but sadly the kind of global power dynamics that have been the case with the OECD will continue to be the case at the UN. And I don't know what the solution is to sort of somehow taming the lobbying corporate power potential to influence policy. And look, we're in this problem now because corporations have had too much power to write the rules that serve their own interests against the interests of the vast majority of people on the planet.
Ade?
Yeah, the fact that the process is now going on in the UN, that's what makes me hopeful, because as I said, we need that international collaboration. So in that sense, I very much agree. That's the level to bring this discussion forward on. And also as an institutional investor, we're very concerned about working on international standards, not developing specific Norwegian standards or regional standards. We have a global portfolio, international companies, and it's much easier for us to promote and work on standards that are international instead of political or regional or whatever. So yeah, those processes are very important to that we can work that we can support.
You want to answer it as well, or?
Yeah, I mean, I think it's important trend also because we see, at least from researcher, for example, because of access to data or the reforms were in certain group of countries. But now we see that having more, for example, if you, another field of my research, as I said, is offshore tax evasion. And there is the Transparency Forum, which includes much more country than just the OECD country, although it's the common reporting standard, so this standard is a OECD initiative. And we see that we can't extrapolate how a policy work from a group of countries because we start seeing like how different are the effects of a reform depending on the country and the tax system, as we were saying, like different, like in developing countries, there are certain taxes that matters more than others compared to European Union. So I think that's an important discussion and trend to have a better, from a researcher perspective, to have a better understanding of how policy are affected from a global perspective.
Thank you. Any more questions? No? Then I think we can wrap it up a bit earlier. And thank you for this very interesting conversation. It's been very fun to talk to you this morning.
Thank you.
Thank you.
Yeah.